Okay, this is one of the question. This is one another question that we are going to discuss. The question name is Lyria. The question name is Lyria. And this is actually an exam question. This is actually an exam question. ACCA pass exam question. And very important question. So first of all, and this is the type of question that examiner examine with question number section B. And in fact, this is the section B question. That's a section B question. So first of all, you have to read the requirement. Discuss with reference to international financial reporting standard. Whether director can classify the stadium as held for sale. Number one. Number two, Lyria company's accounting treatment of the crowd barriers, 31st October X5. And the principle of the accounting for treatment, sale and lease back of stadium. Principle, particularly mention principle. Then next, discuss whether the amortization of intangible relating to television program rights by Lyria company and by industry are acceptable policy according to IFRS, and how to account for players' contract cost, including contingent performance condition and impairment which might be included in the non-current asset, and whether player can be considered as single cash generating unit. These are the two questions, A and B part, one by one. Lyria company is an international successful football club. Lyria company is preparing financial statement for the year ending 31st October X5. Number one, context of the question. That context means here the industry, that's a football club, and the year end reporting date, that's both are important. And facing liquidity problem. Number one, the first issue, stadium sale and lease back and improvements. Stadium sale, lease back and improvements. Okay, one by one. Lyria companies entered into contract regarding its stadium, whereby it will sell the stadium. It will sell the stadium 30th November X6. 30th November X6. What is that date? What is that date? Are standing at 31st October X5, but has entered into a contract to sell the asset or the stadium after the end of next year. Next year will end by 31st October X6. And even after the next year, means after 13 months, and immediately lease back. Number one, they have entered into the contract that we will sell the stadium after 13 months, even after the year end, next year, after next year, not within a year, after 13 months, cross after 12 months, and lease back. So it's a very concern point. Normally, you face the situation that at the year end we have sold some asset and lease back, but here we have entered with the contract that we will sell So the point is that if something about we will sell in the future, that is something about IFRS 5, non-current asset held for sale and discontinued operation. But here non-current asset held for sale. But even non-current asset held for sale will also not applicable because some of the contract of the sale beyond 12 months. Normally IFRS 5 non-current asset held for sale, it's about highly probable to sell the asset within 1 year. But it's beyond 1 year. And the another important point is that IFRS 5 not having mentioned that is any asset which is IFRS 5, it's silent, not mentioned any contract which is about sale and lease back under the scope of IFRS 5 or not. This is another issue. Anyways, the director of Liria company wished to classify stadium non-current asset held for sale in the financial statement for the year end 31st October X5, as they believe the sale is highly probable on that date. The sale contract requires disposal of a stadium for its fair value, 30 million. And for Liria company, lease it back 10 years. So the present value of lease payment at market rates will be 26 million. The market value stadium of this time not changed several years and unlikely to change in the near future. The stadium is being depreciated 5% using the reducing balance method. Do remember, the issue is not only about that, is this about the sale and lease back only? Is this about IFRS 5 non-current asset held for sale? If both not qualify, and if we just mention the question, no, it's not possible to apply IFRS 16 and IFRS 5, the answer is incomplete. Because the question is that here examiner discuss with the IFRS whether director classifies stadium as held for sale. Okay, it's a requirement, but it's examiner expectation that the student must mention if it's not held for sale. Instead, how we will report this, how this asset will report. Yes, of course, if you feel that if it's not applicable IFRS 5, then we have to report its normal IS 16, normally IS 16 about the stadium. Okay, next point. In the year and 31st October XX, it is anticipated 2 million will be spent to improve crowd barriers in the stadium. There is no legal requirement to improve the crowd barriers. Liria incorrectly treated this amount as the reduction of assets carrying amount. Incorrectly treated this amount as reduction in assets carrying amount. And corresponding debit has been to the P&L. Asset credit P&L debit. At 31st October X5, carrying amount stadium after depreciation and reduction of the crowd barrier improvement 18 million. There are two things that need to consider. Number one, A1, A2, that's two things. Whether director classify held for sale, that's one thing. Only specific to IFRS 5. Liria accounting treatment crowd barriers. What the crowd barriers matter? Can we account for that something is going to happen and we have done debit P&L and credit asset without any logic? And definitely we will discuss something about IS 37 provision. Next, the principle of accounting treatment or leaseback at 30th November XX. This part of question this part of question is actually about what will happen at 30th November X6. Let's assume that if you are standing at 30th November X6 and we have made the transaction, sale and lease back, and the details are there, then how will account for the sale and lease back, including the principal? Including the principal. So there are three things that need to consider. Number one, I must say, you have to split your answer in three parts. Make heading, clear heading, all these three. Held for sale, IS 37, cloud barriers, and sale and lease back. And then answer your question accordingly. Number one, the very important thing, this is 13 marks question. And according to marking scheme, the first one having 3 marks. Part A, 3 marks. The number one, IFRS 5 non-current asset held for sale. If a student writing the answer in the examination hall just mention IFRS 5, no need to mention the complete name. There is no expectation of the examiner. Non-current asset held for sale, discontinued operation. No, just IFRS. Requires non-current asset classified held for sale if. Now, reference of standard. Its carrying amount recover principal through sale of transaction rather than continuous sale, and must be available for immediately sale. And for immediately sale, there are number of conditions, but here you just reference the highly probable within 12 months. And the standard only foresee exemption for this rule if sale is delayed by event or circumstances beyond the entity controls, which is unlikely to be the case in this instance. Means after 12 months that will available or not, and something about beyond the entity's control is not relevant. Now, the case, Liria company has entered into firm sale commitment. Firm sale, firm means that's committed, already committed. But the sale will occur after 12 months threshold. Therefore, stadium cannot be classified as held for sale. And additionally, sale and leaseback transaction is outside the scope of IFRS 5, is covered by IFRS 16. This is more than 3 marks. This is not more than 3 marks. Candidates, what do you say? Is that clear, everyone? Once again, I am showing it's not about the mid-mock. Oh, I'm sorry. It's not about just watching the video. It's about whatever you have done during the mock. Compare your answer or identify the gap, what you should have done or what you could do compared to what you have done actually. And also consider that in future, how I will cover that gap. It's not very much challenging if you are practicing the question accordingly. That's the key point. If you are practicing the question accordingly, that's the point. Now, another point, the crowd barriers. We have a plan to improve the crowd barriers. We will spend, no legal requirement. What we have done? Asset credit, P&L debit. Why? Number one, there is no present obligation, legal or constructive. Current obligation currently applies, no. As a result of past payment, there is no possible payment. There is no probable payment. So this is what a quick reference of a standard. Quick, Lyria may decide not to carry out the improvement. May decide means something is liability which is unavoidable. But if something avoidable, we cannot say with the intention of the company, we cannot say that's it's a liability. Especially as the stadium is going to sold and then subsequently leased back. Maybe possible. Someone says that can it be possible that Lyria could withdraw the that particular expense? Yes. It's under the control of Lyria. It may be possible that stadium is going to sold and subsequently leased back. Moreover, the $2 million to be spent on the crowd barrier improvement to the stadium should not be treated as impairment of asset. 31st. We cannot say that is this something about impairment? No. Why you reduce the asset value? Is this something about the impairment? It's not the indication of the impairment. Therefore, the $2 million should be added back to the carrying amount and corresponding credit to the P&L. That means IS 37, no. That means IS 36, no. So that means it's not possible to reduce the value asset. Can you please reply me? Are you people happy? I mean, is there any problem to you? Yes, come on. Can you please reply me? Any one of you share me your experience till now, what you have done related to this part, crowd barriers. Someone please wanted to share his or experience. What you have done with the question. Yes, one of the student answer that shared with me on email, the mid-mock, with the mid-mock, that this one. I'm not mentioning the name. That's part 2, accounting treatment of the crowd barriers. The first important thing that's made the heading, that's good. That's a first possible thing. Number 2, non-current asset held for sale are measured at lower of carrying amount, fair value less cost of selling. Once asset is classified held for sale should not be depreciated. There is no leak. This part is irrelevant because here the crowd barrier matter mentioned or asked by the examiner. It's not actually about non-current asset held for sale. The case is specifically irrelevant about the stadium. The part 1 of the question about the stadium and part 2 about the crowd barriers. But this part of scenario, there is no legal requirement to improve the crowd barrier. Therefore, Lyria should expense 2 million cost and deduction reverse from the carrying amount of the stadium. To some extent, this part of the line is correct. But what the lacking with this answer? What the lacking? The lacking is that you don't have any the answer having not clarity. For example, if you don't mention no legal requirement, it's a point. But why? Because you have to mention it's avoidable. Because you have to mention that it's avoidable. The Leria can avoid because in future they wanted to sell the stadium. That's your answer become complete. Number one, your answer is right that 2 million cost should not be. Your answer is right that deduction should be reversed, but your answer will be wrong. It's mentioning that if you mention that expense of 2 million cost. No, there should be no expense. Number two, the answer is incomplete with the context. With the context of this part as well. IS 36. Means the question mentioned that asset value become reduces. Why? Because there is a matter, you are considering that some reduction exists, some impairment indication. So you have to mention that no impairment indication. Sir, how much the allocated marks related to this part of the question? 3 marks. No, sorry. Crowd barrier, 3 marks. Sir, with this type of question, how much this answer that they have got? What I personally think, you can get easily with that particular point, even one thing wrong, 2 missings, but you will be able to get 1.5 marks. One between 1 to 1.5 marks. Number one, this is irrelevant. But you mentioned that no legal requirement. Your 2 points is right. Deduction should be reversed. So you can get 1 mark or maximum 1.5. Are you getting the point? Hello? Is that fair? Now moving on for the next part. Sale and lease back. Sale and lease back. Sale and lease back. It's by Friday, inshallah, I will try by Friday or Saturday. I will share individually a response to the individually for the answers accordingly, but not now. Don't worry, Taha. I will pick your this part of the questions. Sale and lease back. Sale and lease back. Sale and lease back. Marks allocation. 4 plus 3. What is 4? What is 3? The 4 is about actually accounting treatment. Sale and lease back. Principle. What is the principle? And 3 about what will happen at 30th November X6. Two different things. Number 1, this is all principle. Principle, straight principle. Sale, lease back transaction occur, entity transfer asset, another entity lease that asset back from buyer seller. Buyer lessor. First required criteria IFRS determine whether sale has occurred. And you know very well, for sale and lease back you have to identify sale, yes, sale, no. Under IFRS 16, entity must apply IFRS 15. IFRS 15. IFRS 15 requirements to determine whether the performance obligation is satisfied. If it is concluded that the transfer asset not sale, seller lessee will continue to recognize asset. In this event, financial liability, financial asset recognized by under IFRS. In the case sale will occur 30th November X6 because of the binding sale commitment. Binding sale. So here at this line, with one statement, you have performed two things. That's principle and connect with the case. Principle and the connect with the case. That the principle, if in this case, is seen sales will occur. Why? Because of the binding sale occur. And if the fair value sales consideration equals to the fair value, here the case, the lease payment at the market rates and no need to adjust the sale proceed under IFRS 16. And you have to mention that the Lyria company should follow IFRS 15 to account for sale and apply IFRS 16 as follows. And you have to mention sale and leaseback one by one. Number one, de-recognize asset. Number two, recognize the revenue. Number three, recognize any gain or loss. Number four, recognize any right of use asset proportionate to previous carrying amount. And recognize the lease obligation. Very simple, straight with the reference of the standard. Just putting the connection of the case. How to putting the connection of the case? Mentioning the name. Anything with respect to the case, you have to mention it. That's all. That's all. And you can mention the company, what the accounting entry. I'm not talking about the accounting entry. I will share you the handout. You can just find out accordingly how to calculate. It's simple: cash debit, non-current asset carrying amount. The carrying amount, how to calculate? The carrying amount 18 plus 2. Why 2? Because the crowd barrier cost you have de-recognized, you have reduced the value of asset, that's debited 20 million. And less depreciation. This is the carrying amount at 30th October X5. And your standing for the third part of the question related to after 13 months. So that is what about the depreciation? That's 1 million. You need to calculate by yourself. Whatever the depreciation point. So depreciation for the year 30th 1st October X6 and depreciation for November. That's 12 months. This is 12 months depreciation. And this is 1 month. And that is what about the carrying amount 18.92. 18.92. And right of use asset, it's a formula, it's very basic. That's present value of these assets divided by fair value asset multiplied by carrying amount at the date of the transaction. So it's simple, calculate with this value 16.4. That's 16.4 right of use asset. So is that clear how this point work out accordingly? It's very simple. Now refer to one solution of Taha. First of all, you tell me that how to write the answer. Is that clear? Just a moment. Taha, I haven't received your Mid-mock answer. Where did you send? The email address I mentioned here, SBR by Hussain Qazi. Have you people sent the email to that particular? This email address, SBR by Hussain Qazi? No, you have to send with that particular email address. All of you must have to send with this SBR by Hussain Qazi @gmail.com. All of you must have to send. Yes, all of you must have to send email with there. It's mentioned on the roadmap, huh? It's mentioned on the roadmap. Always send email to here. Yes, you can now WhatsApp. This email ID. Oh, this is not readable. Take a proper screenshot. Ah, this is not readable. Nami, now share me the details with this particular email. Share me the mid-mock on this email. If someone sharing the uh, screenshot, make sure that it's readable. Make sure it's readable. So please make a screenshot in a very clear, in a very precise manner. Can you please resend once again? Okay, but I personally think take a 5 minutes break, a small break. Yes, yes, sure. Take a 5 minutes break. In the meanwhile, you can send 5 minutes break. Take a 5 minutes break. Thank you. 5 minutes break. Okay, once again, this is what the answer of Taha. Taha, is this your answer? Am I right? This is your answer about that? Okay, what Taha mentioned here? Taha mentioned that a sale and leaseback agreement is that in which entity transfer asset to another and lease it back for use. And the first criteria under this standard is to determine whether a sale has occurred or not. Very good. Under IFRS 15 from the contract with customer. If it is concluded that the transfer asset is not sale, then it would be treated as liability. Very good. And then financial asset or liability. Okay. And then use this point here. Entry. Okay. Taha, whatever you have written, that's right. But something missing here. You have, I strongly suggest you have to mention here, what if the IFRS 15 criteria met? You have to make some reference now. Put some reference. That's important. That's key. That's missing. This is the point of that is the missing point. Are you getting the point? Huh? And everyone, you started working directly rather than putting some reference. It's better to put some reference. Like here, you mentioned that here the case that here the case of Niria, the IFRS 15 criteria already met, that asset become derecognized because, put the reference, complete the sentence, because they have made a commitment. We can consider that they have sold. Asset become derecognized. And the IFRS 15 working for sale and leaseback is this. Rest of the working is right. Rest of the working is right. That's whatever you have done accordingly. What I personally think, if the marks of the question, that's 7 marks, that I must say you will be able to get 4 to 5 marks because one reference is missing. I must say that 4 to 5 marks. That is the point. So, but it's a very good effort, Taha. It's really good effort. Really appreciate it. Okay, is that clear, everyone here? Is that clear, everyone here? That's very good. That's nice. So even identifying the mistakes of other students. It's not you, for example, other than Taha. Someone also watching the video and observing that what Taha or previously the other student, what the mistake they have done. It's also the learning for the student, other students as well. Yes or no? Now, the next part, another part of the question. Another part of the question. The next session, the next part. That's a part of this video I have done. And we will discuss, and we are going to discuss the B part with the next session accordingly. Okay, another session, the B part. The B part, in this session, we will discuss the question of Lyria. And the part B. Okay. First requirement, quickly, whether amortization of intangible relating to TV program, television program, content rights by the area company and by industry are acceptable in accordance with IFRS, and how account for player. There are two different things of intangible assets. That's something about television program content rights, and something about the player. How to account for player contract costs, including contingent conditions. Any impairment might be required to these non-current assets, and whether player can be considered single cash generating unit. Single cash generating unit. Now come on. Television program content rights. Linear company has its own subscription-based television station. Subscription-based television station means television station exists and revenue generation is based on uh, revenue generation from subscribers, charging the fees to the subscriber. As a result, it has a material intangible asset. Yes, with the television station, there is a setup, a tangible item, but the contents of the television programs, it's actually the intangible asset, which relate to content rights associated with the television programs. So here we are not talking about the tangible matters. Here talking about the television station, the television programs. The budgeted costs of production are based on estimated future revenues of the television program. Means the production cost which we can consider the production of programs or the production of content rights or the contents considered as intangible asset if that meets the criteria of IS 38. These costs of production are then capitalized as an intangible asset and called content rights. So this is about the situation. The directors of Liria company believe that intellectual property in the content rights is consumed as customer view the television program. So first thing is that content rights, intangible asset and intellectual property. The second discussion is about consumption. Consumption means how that intangible asset needs to amortize. You people know very well, according to IS 38, some of the intangible assets which have a specific life or determined life, definite life, we need to amortize. Where no defined life like goodwill, that's only the case of impairment aspects. But right now we are not discussing no defined life. Discussing the assets which deemed to amortize. But what the method of amortization is the concern point. Consequently, Liria company currently amortize the content rights upon estimated future revenues from the television program. Do remember that according to the IS 38 knowledge, any intangible assets recognized as an asset according to IS 38 needs the criteria of 38. Initially discourage the amortization method based on revenue, until unless it's really justified that asset it's amortizing over the generation of the revenue. If it's normally discouraged, but if we justify that no, contents or the intellectual properties is actually amortized over the revenue matters, then we can do that. So now they want or they do the they do the amortization based on revenue. But the challenge that can we justify this? For example, if a television program is expected to generate 8 million revenue in total, 4 million revenue generated in year 1, and then the intangible asset will amortize 50% in year 1. However, so this is the point how it happens. If the television program expected generate 8 million revenue total, 4 million in year 1, and then intangible will amortize 50% in year 1. So here, as the projected revenue will arise, parallel the asset become amortized. However, industry practice is to amortize the capital cost of the program less recoverable amount over useful life. What industry practices? Industry do practices amortize the capital cost less its recoverable amount over useful life. Means first industry norm is that take out the capital cost, let's any expected future recoverable amount, whatever the remaining, divided by useful life. This is what the plan of industry. Here examiner wants that whether directors whether amortization of intangible relating to television program content by Lyria and industry are acceptable. The very first thing is that either tangible depreciation, either intangible amortization. One thing accounting standard says, the method of depreciation and amortization must be systematic. With IS 38, with respect to systematic, initially discourage the revenue-based method, but if we justify that as the revenue generated, the asset become amortized, we can declare it as a systematic base if this happens. So it means IS 38 not disallowed, but required justification. Another point about the industry, what they do, is this the way out of the systematic? Yes, it's also a systematic way. Just take up the capital cost, intangible asset cost, minus any expected future benefit, whatever the remaining amount spread over the useful life. It's also, we can say, the systematic base. Now, it's about that. Compare the answer. First, what a standard says. Amortization of intangible. Here, the specific issue about 5 marks of intangible amortization. Number 1, this actually paragraph, it's not the answer, it's about the reference of the accounting standard. It's not about the connection of the answer. Number 1, IS 38, intangible asset, sets out rebuttable presumption that amortization based on revenue generated by activity which include the use of intangible asset is not appropriate. This presumption can be overcome when it can be demonstrated that revenue and the consumption of economic benefit are highly correlated. You can rearrange your wordings with this para. That IS 38 about amortization based on revenue initially discouraged, but if we justified the revenue and the consumption of assets, then we can do that. Here the Lyria accounting policy to base amortization intangible for content rights on revenue stream of time seems reasonable and systematic. Why? Because here example has given, if your revenue generation, if your cost is 8 million, revenue is projected 8 million, and if you have earned 4 million, that means 50% of asset depreciated. Do remember, intangible assets are not only the content rights. Intangible assets are a lot of things. For example, softwares. It's not necessary that software will consume according to the company's revenue. But here, we can justify the thing. the content's revenue can match with assets amortization. Okay, the intellectual property embodied television program generate cash flow through channel subscription, and the revenues of television determine the amount spent on the production of TV program. Therefore, revenue reflects the proxy for the pattern of consumption or reflects the pattern of consumption for the benefit received. Revenue and consumption of economic benefit intangibles are highly correlated. Therefore, revenue-based assumption seems to appropriate. I know answer is very extensive, but you can squeeze your words. Here, for example, you say, here the intellectual property, the content rights, revenue generations, and the consumption of economic benefits are highly correlated. So it seemed to be appropriate to amortize based on revenue. Can you please apply me? Is that clear, all of you? Hello? Are you hearing me? Another point. Okay, is that clear? Do reply me. Okay, I'm going to review this point once again. Listen carefully. Asset and depreciation or amortization. What does that mean? Ideally, IS 16, IS 38 says your depreciation and amortization must be as systematic way. Systematic method. What is the meaning of this systematic method? Leave it about the question right now. Systematic means. Systematic method means your depreciation or amortization actually reflect the pattern of consumption. The pattern of consumption, or we can say the usage of asset. Do you agree that? As the asset used, you have to put the depreciation exactly accordingly. Can you please apply me yes or no? Number one, the very important thing. Okay, so pattern of consumption or usage of asset, that should be reflected. So the P&L income statement must charge exactly the pattern of consumption. For example, leave this question. Software a software. For example, we have purchased and its life 5 years. Life means we have taken the rights for 5 years, and we will use throughout the year. We will use throughout the year, and we will use in a straight pattern. My administration, my marketing, my production department will use full throttle over 5 years. What the exact method I have to use here? If I use 5 years softwares, and at the end of the day, there is no residual value, no life or no values. My all company department will use in a very systematic manner, will full throttle over the 5 years. What the method of depreciation I should use? Do reply me. What should be the systematic method? The systematic method here must be straight line. But what if I say the software I have purchased or I have developed here life 5 years, but the highest use at year 1, then the usage become decline to 3, 4, and 5. Usage become decline. Over the life. Then what the method of depreciation which use? Sir, we have to use diminishing balance. And if we are not able to determine the right pattern of usage, and we have a very bumpy situation, somewhere I will use higher, somewhere I will use lower side. It's a very rocky, bumpy. So we can use, if the pattern is not exactly determined, then we will use the hours method. Whatever, for example, 5 years total have, let's suppose 50,000 hours. So we have to use the hourly method. As the hours we consume, then accordingly we will depreciate. So what do you say? These are actually the systematic method for the amortization. In IS 38, discourage the method of depreciation based on amortization, based on revenue, based on revenue. Totally discouraged. In my example, software must not have to amortize based on the revenue pattern of the company. The first thing, how the company generates the revenue, it's not affected the usage of the pattern. Sometime the administration, marketing department will use the software with the full throttle, but we are not able to generate the revenue accordingly. Market competition, COVID-19, a lot of things. But this can be allowed if the intangible asset, if any intangible asset, not the case here, Not the case here. Justified the revenue generation, justified the correlation between the consumption of intangible asset like this case, like intellectual property, content rights, television content rights, and revenue generation. And in this case, actually, it's just allowed, but we can justify it, the Lyria one. Because here the contents is based on the content development revenue is directly correlated with the consumption of the use. Now, do let me know, is that clear? Yes or no? Can you please reply me, is that clear? Actually, here the consent point is that your F7 knowledge is not up to the mark. I know that. Do remember the very important point. Sometimes something's it's hard for the question. Like this. If sometimes something hard in the question, you just have to put your knowledge rather than spend too much time. Because it's hard for everyone. So examiner deliberately put the things accordingly. Okay, this is the first thing. Now, what about the industry practice? Here said industry practice, that is about the carrying amount. What is the matter of depreciation carrying amount? What is the carrying amount of the intangible asset minus the future expected benefit? So whatever the remaining, that means that's used, that's consumed. Means our carrying amount 1,000 and we are expecting to generate the revenue 90,000. So that means the asset, intangible asset, has consumed or has reduced their value of the 10,000. Next year, the carrying amount 90,000, remaining future benefit 70,000. So 20,000 depreciated. The method is also, here the case is acceptable and conceptually sound as it is based on analysis of remaining life of the program and recoverable amount. Such an approach does not contradict prohibition on revenue-based amortization because it is not based on directly matching revenue and amortization. If I would be the student and at the examination, I will not write this. There is no requirement to connect the industry practice with the revenue matters. Rather than according to 38, it's acceptable or not, that is important. So this is what I think additional point. Now, rest of the part. The useful life of the asset is required to reassess according to IFRS standard, at least each financial year end. When this result in a change is estimated, this will accounted for prospectively from the date of assessment. If you use the life, you have to consider reassess the asset's life. If the life of the asset become changed, that's impact on prospectively, not the retrospective. IS 38 also states if the pattern of amortization cannot be measured reliably, the straight line method may be used or can be used hours or units method. That is the point. That is the point. Now the next part and the final part of the question. I hope that all clear now. Is that clear, all of you? Do reply me. Now the last part. Player contract cost. Players. We are the club, football club. And if we hire any player, if you hire any particular player and paid some and committed to pay some amount, or in fact already paid the amount and booked for some particular years, for example 5 years, if you hired the Messi and booked for 5 years, so you can recognize the player cost as intangible asset. So that's the point. So, and if it's intangible asset, that should be justified that you can get the future benefit, number one. Number two, if there are some compromises related to expected future benefit from player, for example, he or she become injured, Messi become injured, that means your asset become impaired. And is this the player as a single asset a cash generating unit? Actually, the cash generating unit matter, as we discussed with the last sessions as well. It's not about the single asset. It's about the group of assets. So here, player registration cost are shown intangible asset, are initially recognized fair value of the consideration paid for the acquisition. However, subsequently, player contracts are often renegotiated at cost. Also, players' contract may contain contingent performance conditions, where individual players may pay bonus based on their success in terms of goals scored or success of the football team as a whole. These bonuses represent additional contract cost. Additional contract cost. For impairment purpose, Lyria does not consider it is possible to determine value in use of individual player unless player was suffered to carry a threatening injury and cannot play in the team. Players only generate direct cash flow when they are sold to another football club. And there are three things with this scenario. How to account for player cost, including contingent performance condition. This is something variable issues. And any impairment which might be required non-current asset. And player may be considered single cash generating unit. Three things. Number one, player cost. And with the player cost, there are some contingent performance conditions that we have paid you some fixed amount and we will pay you any additional amount based on some future performance, may be paid as a bonus based success. Can be possible? The bonus represents the additional contract cost. Can be possible to recognize now? That is a question mark. What do you say? Any contingent performance payments, is it possible to incorporate now? What is that point? Here, examiner, performance condition and contract cost, 5 marks. That is 5 marks. When a player, number one, when player contract is signed, management should make an assessment of likely outcome of performance conditions, like IFRS 15. Some variable conditions. Assess about the likely outcome of the performance conditions. Contingent consideration will recognize in player initial cost if management believes performance conditions will met in line with contract terms. In simple word, if any cost related to tangible or intangible asset that are contingent at the initial recognition, you have to consider what are the likely chances for the payment of that cost. That means one-sided means either to recognize or not to recognize. Number one, if yes, you feel that cost will incur accordingly, you have to add the cost. Otherwise, no. In both the cases, subsequently, periodic reassessment of the contingent concession should be made. Any contingent amount which directors of the area believes payable should be included in the player cost from the date management believes the performance condition will met, either now, either subsequent. And any additional amount of contingent consideration not included in the cost player registration cost will be disclosed separately as commitment. If you have incorporated, that's good. If not, then not reflect in the financial statement but must have to disclose. Do reply me, is that clear, all of you? Number two, about the amortization of the cost of contract based on length of player cost and the cost associated with renegotiating player contract cost should be assessed through residual value, balance of the player contract cost at the signing of the contract extension. Revised carrying amount should be amortized over the remaining renegotiated contract length. This is about the residual balance, not the residual value. Not the residual value. Clearly, the cost associated with renegotiation of playing contract should be added to residual balance of contract cost at the date of signing of contract extension. For example, this is all about subsequent. For example, one of the player is signed for 5 years. After 5 years, you wanted to extend the contract for the 2 years. So whatever the renegotiated after 5 years, that is called residual balance. And that remaining residual balance should be spread for further 2 years period. That is called the revised carrying amount should be amortized over the remaining renegotiated contract length. So first thing, initial recognition of cost. Second thing, contingent consideration. Then, if there is a time for renegotiation. Now, can you please reply me, is that clear for this paragraph, the last paragraph? Is that clear right now for renegotiating? Just Taha, can you please reply me? Okay. Now the second part is about impairment. Impairment. What are the conditions about the impairment? And for impairment, another point is about CGU. What the condition of impairment about impairment here? Where a player sustains a career threatening injury, that means future benefit is compromising, expected to compromise, and is removed from playing team, the carrying amount of individual would be assessed against the best estimate of fair value less cost to sell. And any impairment charge. Question mentioned that there is no possibility of value in use. So how can you check the impairment test? carrying amount versus fair value less cost of sales. And impairment charge made in operating expense reflect to the impairment loss. So how to make impairment test carrying amount versus recoverable amount, and here recoverable amount is only the fair value less cost of sale, no value in use. Finally, it is unlikely that any individual player can be generated or can be a separate single cash generating event. And this is likely to be playing a squad. Also difficult to determine value in use individual player. In isolation, as player cannot generate cash flow on their own unless via a sale. That is all about the case. What I personally think, this linear complete question, A part is comparatively easy as compared to B. But always remember, one question having multiple complexities. But on the other hand, it's not possible that one question always have 100% difficult part. Some part difficult, some part easy. And mark my word, no students, there is no possibility that a student become fail if he or she attempt wrong, the hard aspect of the question. But students will fail the exam if he or she become mess with the hard part and even wrongly attempt the easy part of the question. That's why, in simple words, read the question, whatever the easy parts, just catch the all easy parts. Stick with the principles. Principle means knowledge, connect with the case. And whatever the hard part, you just show your best knowledge with the principles. That is knowledge and the case. That's all. And put your effort to make an appropriate solution, not the accurate. Appropriate solution. What's the appropriate solution? Appropriate means mixture of easy and hard part. Inshallah, may Allah willing, may Allah God willing, you will qualify the exam. So candidate, that is all about the today's session. I hope that today's session will support you in a manner that what you have done with the mid-mock and what's the difference. And I hope that you have become motivated to perform in the future, how to attempt the questions. That is what all about the mid-mock matters. The important thing is that now you have to focus on your regular studies to follow the roadmap as soon as possible. Complete the roadmap as soon as possible. And in the meanwhile, inshallah, by Friday or Saturday, I will give you another line of direction about the practice questions. Some live, some recorded, the combination. And you have to attempt with the multiple practice questions accordingly with the exam question. Okay, thank you very much from my side. And I really appreciate that all of you who are taking the live session must have to make a constructive feedback on the WhatsApp group. Any of the WhatsApp group, either SBR talk or in the SBR classroom. If you are added with both one, you have to share the feedback on there. So next of the students must be motivated with that constructive feedback and start preparation with the right direction. So I really appreciate if you share your constructive feedbacks to the relevant WhatsApp groups. Thank you very much. That is the that is what I regard from your side. Jazakallah khair. Assalamu alaikum. Any of the question you can ask on the WhatsApp group. You have any question you can ask here. You can ask here. Any of the question is that. Jazakallah khair.